We're talking millions, sometimes even billions of dollars on the line here. Picture this. A company proudly announces record profits, massive asset growth, and zero major liabilities. Investors are cheering, the stock price is soaring, but there is one massive, multi-billion-dollar question hovering over the entire celebration. How do we really know a company's financial statements are actually true? How do we know management isn't just making the whole thing up?
Welcome to The Explainer. Today, we're putting on our detective hats. We're going to unpack the fascinating world of audit evidence and verification procedures. Because auditing isn't just about crunching numbers in a dusty back room, it's a highly structured, rigorous corporate investigation designed to separate financial fact from corporate fiction.
Okay, let's dive right in. Here's our roadmap for today. First, the core of audit evidence. 2, the auditor's toolkit. 3, cross-examining with confirmations. 4, verifying assets and liabilities. And finally, ensuring audit quality control.
All right, Section 1, the core of audit evidence, uncovering the clues.
Every good detective needs clues, right? Well, what exactly is audit evidence? Basically, it's all the information an auditor uses to arrive at their final conclusion. But here's the big takeaway for you. It's not just the accounting records. I mean, sure, it includes the ledgers, the journal entries, and the spreadsheets. But it also includes stuff like meeting minutes, analyst reports, and direct observations. It's literally every single piece of information, internal or external, that helps the auditor build a totally rock-solid case.
Now, an auditor can't just grab any evidence. They need the perfect balance of 2 crucial elements, sufficiency and appropriateness. Sufficiency is all about quantity. How much evidence do you actually need? Well, if an account has a super high risk of being misstated, you're going to need a lot more of it. Appropriateness, on the other hand, is about quality. Is this evidence reliable? Is it relevant? And here's why this matters so much. These 2 things are deeply connected. Just getting a massive pile of bad quality evidence, that doesn't fix the problem. Finding more bad clues doesn't solve the crime.
Let's see how this builds a clear hierarchy of reliability. Because let's face it, not all evidence is created equal. The absolute gold standard? That's evidence you get from external independent sources, totally outside the company. Right below that, you've got internal evidence, which is considered way more reliable if the company's internal controls are actually effective. Then you've got direct auditor observation. Seeing an inventory count with your own 2 eyes is vastly superior to just asking an employee how it went. And finally, original documents are always going to beat out photocopies or electronic scans. Hands down.
So, we know what our clues look like. Now, let's open up the briefcase. Section 2, the auditor's toolkit. Methods of investigation. Auditors actually have 7 primary tools at their disposal. Let's run through them. They use inspection for records and tangible assets, and observation to watch processes happen in real time. Then there's inquiry, basically interrogating knowledgeable people, and confirmation, which means getting direct written proof from a third party. Next up is recalculation, which is exactly what it sounds like, just checking the math. Then reperformance, where the auditor actually executes the company's control procedures themselves. And finally, analytical procedures. This is where you study the plausible relationships between financial and non-financial data to spot any weird, unusual fluctuations.
Now, what's genuinely fascinating here is this whole concept of assertions. Think of it like this. When management hands over those financial statements, they're essentially giving you their alibi. They're implicitly or explicitly making assertions. They're claiming that transactions actually happened, that assets truly exist, and that everything is fully complete and properly valued. The auditor's entire job? Take that toolkit we just talked about and test whether management's alibi actually holds up to scrutiny.
But sometimes, the suspect's word and their internal files just aren't enough. Let's hit Section 3, cross-examining with confirmations, witness interrogation.
One of the most powerful tools in the box is the external confirmation, especially when checking if debtors actually owe the company money. Now, auditors use 2 methods for this. A positive confirmation asks the third party to reply in all cases. They have to explicitly state whether they agree or disagree with the balance. But a negative confirmation, that asks the third party to reply only if they disagree. You can probably spot the massive risk here, right? A debtor might just toss the auditor's letter straight in the trash. If the auditor gets 0 replies, they might falsely assume the debtor agrees, when in reality, that letter is just sitting in a landfill somewhere. That's exactly why negative confirmations are really only used when the risk is super low and internal controls are rock solid.
And this brilliantly illustrates exactly who the auditor cross-examines. To get real proof, they go straight to specific, independent sources. They go directly to the bank to verify cash balances, loans, and guarantees. They write directly to solicitors or lawyers to verify the existence and potential cost of pending lawsuits or claims. And they go directly to debtors to verify accounts receivable balances. Bypassing management entirely to get this independent verification is absolutely crucial.
But let me ask you this. What happens when the auditor just doesn't know the answer? I mean, auditors are experts in accounting, sure, but they aren't engineers. They aren't actuaries. If a company claims to have 50 million barrels of oil sitting underground, an accountant really can't verify that. That is exactly when the auditor has to call in an expert witness, a professional with specialized skills. The auditor will rigorously evaluate their competence, their objectivity, and their accuracy, just to ensure those financial numbers are anchored in actual reality.
And you know, timing is absolutely everything in this kind of investigation. Ideally, auditors want to send out those third-party confirmations right at the year-end date. But if time constraints make that impossible, the absolute maximum recommended time prior to year-end to send out a circularization is just 2 months. No more than that. And even then, the auditor has to run some really strict reconciliation procedures for that intervening period, just to make sure nothing funny happened in those final 8 weeks of the year.
All right, moving right along to Section 4, verifying assets and liabilities. Securing the crime scene. When an auditor is verifying any asset, they have to systematically establish a few key things. And I want you to remember this incredible mnemonic for it, CAVE Bob. First, the auditor checks the cost of the asset. Then authorization, who actually approved buying this thing. Next, they assess its current value. They physically verify its existence. They confirm beneficial ownership, like does the company actually hold the legal title, and finally presentation, is it properly disclosed in the accounts? Honestly, memorize CAVE Bob. It is pretty much your ultimate mental checklist for financial truth.
Now, when applying these tests, auditors definitely don't just pick accounts at random. Oh no, they are actively hunting for anomalies. They zero in on high-risk accounts. We're talking debtors with weird credit balances or active accounts that suddenly drop to nil balances. They intensely scrutinize heavily overdue accounts or accounts with suspicious special reductions right before year-end. And, perhaps most importantly, accounts connected to the company's own directors or officers. They are looking in the exact places where manipulation is most likely to hide.
And this whole verification process isn't just a single event, it's a chronological flow. During the planning phase, they sit down and assess the company's internal controls. Then, during field work, they're right out there on the warehouse floor observing the physical inventory counting, making sure what's on the spreadsheet is actually sitting on the shelf. Finally, in the post-year-end phase, say a debtor didn't reply to a confirmation. Well, the auditor will review subsequent cash receipts. They'll check the bank statements after year-end just to see if the customer actually paid the bill.
Which brings us to our final part, Section 5, Ensuring Audit Quality Control, Standard Operating Procedure.
Look, if the detectives themselves are sloppy, the entire investigation falls apart. That's exactly why every reputable audit firm operates on a really strict hierarchy of control. At the base level, you've got the audit trainees grinding out the foundational fieldwork. Their work gets reviewed by the audit senior, who then gets reviewed by the manager. But the ultimate responsibility for the quality of the audit, that final sign-off swearing the financial statements are true and fair, that rests entirely with the reporting partner at the very top.
But that begs the question, who watches the watchmen? Well, to mitigate negligence and fend off massive lawsuits, the industry uses a fascinating system called peer review. This is where an audit firm literally opens up its systems, its procedures, and even its past files to be investigated by another competing audit firm of a comparable size. It's essentially auditing the auditors. It acts as the ultimate quality safeguard, ensuring that training, independence, and procedures stay razor-sharp across the whole industry.
So, the crucial point we need to understand is this. Despite all these amazing controls, auditors simply cannot check 100% of a massive corporation's transactions. They just can't. They have to rely on sampling. And that naturally introduces two massive risks. First, sampling risk. This is the mathematical danger that the sample you picked just doesn't represent the whole population. You miss the fraud simply because you didn't pull that specific file. Then you have non-sampling risk. This is basically human error. You pulled the fraudulent file, but maybe you used the wrong procedure, or you just misinterpreted the evidence and completely missed the crime anyway. Which leads us to a pretty profound final thought. Think about it. If an entire audit fundamentally relies on sampling, testing, and professional judgment, can we ever truly be 100% certain that a company's financials are flaws? The reality is, an audit provides reasonable assurance, not an absolute guarantee.
It is an incredibly robust, highly structured investigation for sure, but the pursuit of financial truth, it's always going to be an ongoing challenge. Keep questioning, keep analyzing, and never ever take the numbers purely at face value.